News, kind of good news for me because I don't have to check the data every day anymore to watch it, wait for it to take over as well.
I'm sure you do, actually, in case it goes back down.
Yeah, exactly.
The royal symbol of Britain's free market economy, the London Stock Exchange, is plummeting. How have the home-to-world dominating industries slumped in recent years? Even home companies started to pick other markets to list their shares over the British. Is it because of the weak productivity, Brexit, or a possible recession coming soon? Since Prime Minister Margaret Thatcher unleashed a wave of privatisation in the 1980s, London has been home to companies that dominate global industries, including AstraZeneca plc, Shell plc, and HSBC Holdings plc. However, in recent years, there's been a lack of money from investors who actually want to invest in UK stocks. At the turn of the century, UK stocks and shares accounted for around half of the money tied up in UK pension funds. Today, they represent less than 10% of assets. So, what's exactly gone wrong? Companies raised just $1 billion on the London Stock Exchange in 2023, the lowest since 2009. The underperformance was London's failure to secure the listing of one of the UK's most important technology companies, Cambridge. English-based chip designer ARM Holdings plc. The activity has shrunk dramatically from its peak before the global financial crisis, with the average daily traded volume on the FTSE All-Share Index falling to about £3.4 billion in February 2024, from £15 billion in the same month of 2007. London's allure as the center for IPO activity has also been diluted. Why? Headlines about companies leaving London for other exchanges have hurt the city's image as a place to conduct IPOs. In February, London's shrinking stock market suffered as a fresh setback after a $20 billion merger in the packaging industry said it could move its primary listing to the USA. So how does London lose? Well, there's an alarming sense of resignation in the air, at least about London's warning status as one of the world's preeminent financial capitals, as if it can never again compete with New York. But that's self-defeating and risks becoming a self-fulfilling prophecy. European cities like Paris and Frankfurt are already snapping at London's heels. The value of US stocks almost trebled to $53 trillion. Paris overtook London as Europe's largest stock market in 2022. London is now only the 7th biggest globally, trailing the US, China, Japan, Hong Kong, and even India. This is a powerful reality check for an institution whose history stretches back more than 200 years. So, you might be blaming Brexit for all these happenings, but wait. To be honest, it's hard to draw a direct channel. What's clear is that Brexit has forced banks to beef up their presence in rival financial centers such as Paris, Amsterdam, or Frankfurt. So is Brexit a real factor? Well, in 2023, the UK capital's share of European IPO proceeds fell to 7.1%, the lowest since the global financial crisis. That is, the decline began well before Brexit and the coronavirus pandemic, as a deeper productivity crisis pushed Britain's economic performance into the slow lane in relation to other G7 nations. So who else is to blame? In the early 2000s, the UK government introduced new rules forcing retirement fund managers to be more open about their investments and about how they plan to meet future pension obligations. What's more, the little equity allocation funds retained were increasingly invested in stocks in other markets as they tried to diversify their holdings. UK pension funds have held 1.6% of UK-listed stocks in 2022, down from about 32% in 1992, according to data from the Office for National Statistics. So, did the UK government try to alleviate it? Well, in December, the UK's finance regulator announced its latest plans to simplify its listings regime and revive interest in London's stock markets. The Financial Conduct Authority confirmed it will replace the standard and premium listing rules with one set of streamlined eligibility and ongoing requirements. They're planning to let companies carry out more activities without putting them to a shareholder vote. The Chancellor of the Exchequer, Jeremy Hunt, was additionally planned to create a tax-free savings account for investing in British stocks, a so-called British ISA, and require pension funds to disclose their allocations to different UK asset classes. Well, let's see how much is going to be implemented. the UK has never been able to match the general enthusiasm that seems to come so naturally to corporate America. Even after the financial crash, people maintained a quiet optimism about our ability to recover from major crises. So, the investment community only has itself to blame. It's all well and good, and I am expecting the government to come to the rescue. There are, of course, ways that ministers can, but are they trying to help by removing regulatory barriers? As economists argue, it's the demand side that really needs addressing, because if fund managers are not willing to put their money where their mouth is and back risk, then why would anyone want to list there in the first place? What's your opinion on this matter? Does the London stock market regain its rank in the near future? Comment your thoughts and share the video. Keep on watching for more updates and videos, and hit the like and subscribe button.